Hey guys, welcome back to Andrew Invests. Back to the usual investing content this week, as it was a huge week for earnings and I've been really looking forward to discussing them with you. So some of the major companies in my portfolio reported this week, including Meta, who smashed it, Google, who smashed it, Visa, who did pretty good, and even Crocs, who sold off pretty significantly after their earnings. I actually thought that they had a pretty positive one. So today I specifically want to go into Crocs' earnings in a bit more detail, as well as Meta, and show the juxtaposition between the two companies who both had a great earnings, but the stocks went in the complete opposite direction after them. So let's start off with my passion project, Crocs. So Crocs beat on earnings per share expectations, revenue expectations, and it raised its full year guidance for earnings per share. So what's not to like? Why did the market sell off by such a huge amount? Well, it all comes down to this tiny factor. Crocs reduced its full year expectations for HeyDude revenue and profit growth. That might seem kind of minor to you, and Crocs has a history of selling off massively after doing a great earnings. It happened in Q1 because Crocs reduced their expectations for this quarter's earnings, and the market sold off massively despite it raising its full year revenue expectations. Now, what happened with that? Well, Crocs actually absolutely destroyed its earnings per share expectations compared to what it had predicted last quarter. Let's listen to a brief clip of Andrew Rees, the Crocs CEO, talk about his expectations for HeyDude and kind of talk about why it didn't perform as well as expected by analysts.
It's a relatively new brand on the whole consumer landscape. So I think there's a tremendous amount of nervousness around the brand. We did lower our expectations for the rest of the year for the brand. That's really related to our wholesale business. As we see the bookings for the business, I think the wholesale channel is nervous about what's going to happen with the consumer in the back half of the year. They're dealing with some overstocks from some other brands. They don't have strong history on HeyDude. And unfortunately, because of our constrained warehouse capacity, we don't have a lot of capacity to do a lot of at-once business. So it's short-term orders that they might put in and respond to them quickly. Over the long term, we will fix all of those things. We have a new warehouse opening later this year, which will put us in a great position for future. And we have a very strong level of confidence in the brand for the future over the long term.
What Rees is effectively saying is that their wholesale partners are a bit nervous about the state of the American economy and about whether, if they make wholesale buys, whether they'll be able to sell all of the HeyDude stock. So they want to buy on a more one-to-one sale basis with one sale to a consumer, meaning one buy from Crocs. But Crocs doesn't yet have the warehouse capacity for that, but they're in the process of upgrading. So I do tend to believe what Rees is saying, and I do think there's potential for HeyDude in the future. And I don't think it's the disaster that many are pointing it out to be. When we look at a comparison of the full year guidance from Q1 versus Q2, it's improvements almost on every single point. There's improved revenue growth overall, improved Crocs revenue, operating margin is higher, and earnings per share is significantly increased. The only negative is that HeyDude is predicted to grow at a slightly slower rate than what was predicted before. At 14 to 18%, I personally don't think that's that bad at all. And if you account for the hiccups Rees mentioned, I don't think it's a problem. Now, one factor that I've raised before in previous videos on Crocs is the large amount of debt that they took out in order to buy HeyDude in the first place. That gave them a net debt of nearly $2.8 billion. And since then, they've been paying it off at a very rapid rate. This quarter, it hasn't changed at all. They paid off around $200 million worth and reduced it to now being $1.9 billion. I was really impressed with that, and that also signals that the company is going to start buying back shares, which is another boost for investors, even though personally I would rather they just focus on paying even more debt. I'm not going to complain. How does this earnings affect my own personal position in Crocs? Well, it hasn't changed at all. I've been buying a few shares in Crocs here and there over the last few months. I don't want my position to become too large because it is still a bit of a risky play, but this doesn't change it at all. With the drop in the price, I plan to probably buy a few more shares in the next few months, certainly whilst it remains under $110 per share. Now, what's the risk? Well, obviously the market is taking this particular risk quite well or heavily, and that's that Crocs is basically a fad that's going to die off. Personally, I don't think that's the case. I think that Andrew Rees is an excellent CEO who's made the company turn around from being a fashion fad and actually made it become a cultural icon. In addition to that, HeyDude is still growing, and I still think there's a lot of potential for the brand. I trust Andrew Rees on it, and I believe that it will do really well over the coming years and act as a growth driver as well.
Meta reported better than expected earnings yesterday, announcing double-digit growth for the first time since 2021.
Next up, let's talk about Meta. So Meta and Zuckerberg confirmed this week that Threads had lost around 50% of its active users. It didn't come as a surprise to me. I predicted it in my previous video. And personally, it doesn't come as a disappointment either, as Threads was only ever a bonus if it worked to me. And if it didn't work out, then it's fine. It's only a small amount of cash being invested in it. A very small team worked on it. But in other news, there was a huge bonus for Meta investors when earnings came in and Meta beat on every single expected metric, including monthly average users, daily average users, revenue, and earnings per share. A lot of people were shocked, as people have been saying that Facebook has been dead for a long time now, but that clearly isn't true. Now, analysts have raised their price target on Meta continuously this year, and I think it's ironic that they've done it again after earnings, after their prices shot up yet again. They've raised their targets to a price of what would be an all-time high around $380 per share. Now, personally, I think it really shows the fallacy that the market is 100% efficient. If you'd bought into Meta at the start of the year, you would have made an over 160% gain on the stock. Do you really think that all of the information in the market was fully priced into the stock at the time? No. Now, some of you might think that it was an obvious decision to buy Meta at the end of last year. But in reality, it was completely different of an environment. The media and everyone was saying that Meta was about to collapse. The stock price was collapsing, earnings were collapsing, TikTok was taking over, and nobody was using Facebook or Instagram anymore. But if you had the strength to follow your convictions and buy the stock, you would have made a huge profit. At the moment, do I think there's more room to run for the stock like the analysts? And I think the answer is yes. The stock currently sits at a fairly expensive 42 trailing price to earnings ratio, but when you take into account analysts' estimates for future earnings, the company is sitting at under a 15 forward price to earnings ratio, which makes it the cheapest in big tech. And the same story is true for free cash flow. If we look at the free cash flow yield of Meta post stock-based compensation adjustment, it's pretty meager at 1.3%. But that doesn't take into account the fact that the last few free cash flow quarters for Meta were so low. Were we to assume there was literally no growth in free cash flow for the next 3 quarters for Meta and assume that free cash flow is 11 billion per quarter, that would make their free cash flow nearly increase by 80%, which would mean this could increase to around 5.6%. Subtracting stock-based compensation, it would still be at around 3.6%, which is pretty healthy when you compare it to other big tech companies like Microsoft that are trading at around 2% free cash flow yield. What did we learn from the earnings of Meta itself? Well, nothing that unexpected, but what I was most impressed by was the monetization of Reels. Reels are those short-form videos that you'll see on YouTube Shorts or TikTok, and Meta was having a real problem with actually making any money from them last year, as content has transformed into short-form video format. Now, this year, they've actually increased the revenue to a point where they're nearly catching up with TikTok, and I was really impressed with that in particular. In addition to that, Meta is still innovating with AI. It released its open source Llama project, and it's been spending more money on the metaverse. Although that is the one downside that I would say from the earnings report, or maybe one of two, that even more money has been plowed into metaverse. But as I always say, that if it fails, then that money will go straight back into the free cash flows. So I wouldn't worry about that for the long term. But the other thing that I thought was slightly disappointing was the fact that the company really slowed down their rate of share buybacks. And that's probably because they think the company is quite expensive at the moment. But like I said previously, I don't think the company is that particularly expensive. And I think that the company should just keep plowing money into buybacks until the forward price to earnings is, a bit higher than what it is right now. But if you did enjoy this video, please give me a like and subscribe, and I'll see you guys next time.